You're about to watch the familiar dance of money and math unfold. Every quarter, silently, predictably, the largest dividend-focused ETFs quietly reinvent themselves. But this month, something subtle and potentially unsettling is about to happen with SCHD. Most investors won't notice. The headlines won't scream. Yet for anyone holding SCHD, the decisions made behind closed doors this month could ripple through portfolios in ways few anticipate. And here's the uncomfortable truth. The changes aren't just about which stocks go in or out. They're about the invisible forces that dictate which companies get rewarded and which ones get left behind.
Let's start with the basics so we can get to the part that really matters: performance and yield in a very specific way. It pulls from the Dow Jones U.S. Dividend 100 Index, meaning it cherry-picks the highest quality dividend-paying companies in America. On paper, it looks simple. Buy the stocks that pay steady dividends, weigh them by yield and financial strength, and hand investors exposure to reliable income. But underneath, there's a complex mechanism at work, a reconstitution that happens once a year, often in March. And here's where it starts to get interesting.
When SCHD reconstitutes itself, it isn't just shuffling a deck of companies. It's performing a surgery on the portfolio, cutting what doesn't meet the criteria and grafting in what does. Companies that once seemed untouchable can get kicked out. Meanwhile, lesser-known players, sometimes flying under the radar, get promoted. The rules aren't arbitrary, they're mechanical, but their consequences are very real. So why does this matter now? Why should anyone care about SCHD's shuffle this month? Because history tells us that the days following a reconstitution aren't neutral. In fact, they often create the kinds of price distortions that traders and algorithms love to exploit. Companies being added to the index can see sudden inflows of capital, while those being removed might experience quiet outflows. It's subtle, but the math is exact. And for anyone paying attention, it can mean the difference between catching a small gain and watching a position drift lower without obvious reason.
Let's unpack exactly how this works, step by step. Step 1. The selection screen. SCHD doesn't just pick any dividend-paying stock. It screens for 4 key factors: dividend yield, dividend growth, payout ratio, and financial strength, which itself is calculated using return on equity, debt-to-equity ratio, and cash flow metrics. This is where the system starts to show its personality. Companies with high yields but shaky finances often fail the strength test. Meanwhile, solid companies with moderate yields can get promoted. The result is a blend of safety and income that looks steady on paper, but it's a moving target. Step 2. Ranking and weighting.
Once the pool of qualified candidates is established, SCHD ranks them by yield, adjusted for financial strength. This isn't a simple 1 to 100 list. Each stock gets a weight in the portfolio, meaning some positions are tiny, others represent multiple percentage points. And here's the catch. A few percentage points may not seem like much, but for a $20 billion ETF, that's hundreds of millions of dollars shifting into or out of a single stock. Step 3. The announcement and timing. Schwab usually announces the reconstitution in mid-February, with changes effective in mid-March. Traders and funds that track the index can start positioning themselves immediately.
This is why some stocks experience noticeable volatility in the weeks leading up to the effective date. It's a quiet but predictable rhythm, a rhythm most retail investors ignore. And that's where the irony comes in. Most people think dividend ETFs are boring. They're slow and steady. Yet behind the scenes, the quietest funds can be some of the most mechanically precise drivers of market movement. It's like a symphony playing out on the NASDAQ and NYSE, and SCHD is conducting a large section of it. Now let's talk about the math that no one highlights. When SCHD removes a company, it doesn't just mean that the stock is less attractive. It triggers a cascade of mechanical selling.
The fund must offload shares to match the new index weight.
That can temporarily depress the stock price, regardless of whether the company's fundamentals have changed. Conversely, a company being added sees new buying pressure. But here's the subtlety. The size of the inflow is tied directly to the company's weight in the index and the total assets under management of SCHD. In other words, it's not just a stock going up or down, it's an exact, calculable shift in billions of dollars of capital. And this is where most investors miss the nuance. The changes are predictable. They are documented, yet the timing and magnitude are rarely considered when people make investment decisions. That creates both opportunity and risk. Which brings us to a key point. The market's reaction to SCHD reconstitution isn't about the company's future growth or dividend safety.
It's about technical flows. How much money must move in or out to match the index? Fundamentals take a back seat for a few weeks. And that's precisely why some otherwise solid stocks can underperform during this period, while others temporarily outperform. Let's put some numbers to it. SCHD currently manages roughly $30 billion in assets. A company that makes up 3% of the index suddenly sees $900 million in buying pressure when added. That's not hypothetical. It's literally money flooding into the stock on a set schedule. Conversely, a 3% removal triggers $900 million in selling. And for mid-cap companies, that volume is not insignificant. It can move prices several percentage points within days.
Now, consider the broader mechanics of market psychology. Curious. When traders know these flows are coming, they often front-run the ETF, rising energy. That means prices adjust before the actual reconstitution date. Stocks being added might rise in anticipation, while stocks being removed could fall preemptively, slow. By the time the official shuffle occurs, part of the move is already priced in, but not always fully, serious. And that's where the strategic eye can spot anomalies. Emphasis. Here's the disconnect most people have. Curious. Popular finance media often frames SCHD and similar ETFs as stable dividend plays for long-term investors. And they are, in a broad sense, calm. But during reconstitution, stability is a bit of a mirage. Serious. The ETF's construction ensures income reliability over years, but the short-term mechanics can create volatility that is anything but boring.
It's a subtle but crucial point. Dividend reliability doesn't mean price immunity. It doesn't mean set it and forget it during index reshuffles. The ETF's framework may promise consistency, but the market's response can be precise, swift, and even if temporary, sharp. And this month, the stakes are slightly higher than usual. Several mid-cap dividend growers are on the cusp of qualification. Their financial strength scores are just enough to push them in or barely fail and get left out. Small swings in metrics, or even in reporting adjustments, could tip the balance. For investors holding these names, or funds tracking SCHD, the difference between inclusion and exclusion could create noticeable price ripples.
Here's another subtlety, the correlation effect. SCHD isn't isolated. It moves in tandem with other dividend-focused ETFs that track similar indices. When one fund adjusts, others often follow, either mechanically or via imitation. That creates a multiplier effect. A few companies added to SCHD could see not just $900 million inflows from Schwab's fund, but also additional inflows from Vanguard, BlackRock, and smaller dividend trackers mimicking the same rules. The result? A concentrated, almost algorithmically amplified market move. Which is ironic, isn't it? A fund designed to give calm, steady income is quietly orchestrating some of the most systematic, predictable swings in certain stocks.
Yet few outside the trading floors notice. Most investors are busy reading about dividend yield and portfolio stability, unaware that there's a silent tide moving underneath. Now let's zoom out. Why does any of this matter beyond the mechanics? Because it exposes a hidden risk in seemingly safe strategies. Even if SCHD itself performs as expected, individual stocks may experience volatility unrelated to fundamentals. Investors expecting smooth sailing could be caught off guard. And it highlights a broader truth about ETFs in general. They promise diversification and stability, but they operate on rules, and rules can create predictable pressure points.
Serious, front-running ETFs is a crowded trade, partly because actual inflows are massive and markets anticipate them, and partly because the invisible hands, algorithms, quant funds, and institutional traders often react faster than most retail investors can. So what could SCHD look like after this month's reconstitution? We can make some educated guesses. A few solid mid-cap dividend growers are likely to join. Some overvalued or weakly financed large caps might be removed. Short-term price movements could favor new entrants by a few percentage points, while exiting names may see modest declines.
The overall yield of the ETF might shift slightly, perhaps a basis point or two. But for long-term, income-focused investors, the impact on dividend collection is minimal. Yet the market doesn't care about minimal in the short term. For traders, a 1 or 2% swing in a stock can be a windfall. And for the companies themselves, being added or removed from SCHD carries more than just capital. It carries perception. Inclusion can signal financial robustness, while removal, however mechanical, can raise eyebrows. And if a fund designed for safety can create predictable waves, what does that mean for markets built entirely on rules?